My first post this week was about US imports and exports of energy-related petroleum products. We've seen an interesting trend where the first 8 months of 2022, the US was a net importer of these petroleum products. In the subsequent 10 months through June of 2023, the US became a net exporter of those products. What's interesting about that is global crude oil supplies are increasingly constrained. We've heard about the OPEC cutback, for instance. And because these supplies are increasingly constrained, the world is turning more to the US to meet its petroleum-based energy needs. And that's part of the reason that we have seen US oil prices climb within the past month, 2 months, that kind of thing, up to the levels that it's at because of this new global demand that the US is increasingly trying to meet. So one more data point around this idea that supply and demand dynamics are shifting in the crude oil space, and the US producers do stand to benefit from a lot of these changes. My second post this week was about forest products, and I wrote about Weyerhaeuser, a massive American forest products company. And what they do is own timberlands. They cut down a small fraction of these timberlands each year to turn those into logs that then become boards and other wood-based products, and then those go out into the supply chain from there. What's interesting about the forest products sector generally is it has ridden a wild roller coaster over the past 5 years. I charted Weyerhaeuser's revenue and operating margin and return on capital employed and stock price starting in 2018 and marching quarterly through the most recent quarter. What we see is this boom as the pandemic sets in, which we probably all remember when lumber prices just went to the moon. And you see the same exact thing in Weyerhaeuser's financial results, where revenue, profitability, returns all jump up as you make your way into 2022 and stay at elevated levels mostly through 2021 into the beginning of 2022. And that's where we start to see this roll off back to the kinds of levels that we had been seeing before the pandemic set in. So unfortunately, 2023 levels are even a little bit below for Weyerhaeuser where they were in 2018. That's largely the case for the sectors. We've returned back to what you would have considered normal. And what's crazy is just if you look at 2018 versus today, you might see a very slow grind downward, but you miss all this really interesting madness that just happens in the middle. So I've found that particularly interesting and wanted to explore Weyerhaeuser as an example of the forest product space, which I do intend to lean a little more into going forward. That space is interesting. There's some real carbon implications to that sector. And so I do intend to explore that a bit more as we move forward. My third post this week was about Energy Transfer announcing its $7.1 billion acquisition of Crestwood, or at least its intent to acquire Crestwood. And the post there I wrote because when I looked through Energy Transfer's press release announcing that these two companies had entered their merger agreement, I found a really interesting line about pretty high up in the synergies section about Energy Transfer saying, look, we can save quite a bit of money by refinancing this debt that we're going to take on from Crestwood. And we didn't see a whole lot of that before interest rates started to rise. Now that interest rates are much higher than where they were a year ago and certainly 2 years ago, financing costs matter even more now than they have in the past. So when we see energy merger and acquisition deals, we're going to increasingly hear talk about financing costs. And those are things that we didn't see a lot for the prior 10, 12, 15 years. So it's something that we expect to see more of going forward. This notion of balance sheet quality and the stress that we start to see from higher interest rates just means we'll have a slightly new dynamic around energy M&A to pay attention to going forward relative to what we've had in the recent past. My fourth post for the week was about US GDP growth. And I pointed back to the GDP Now tool, which is something that I've written about here and there over the past year or so. It's a tool from the Atlanta Fed that shows what it does is it just ingests a whole bunch of macroeconomic data and estimates what would the US report its GDP growth as if all we had was access to the macroeconomic data that have already been published. And it shows Q3 GDP growth at plus 6%. Whereas when you look at the consensus forecast across the major banks, you're looking at a range of 1% to 2%. That delta gets really interesting and some of the biggest separation I've seen between these data-driven forecasts and what we'd get out of the big banks. And I use that as evidence of the fact that there's real uncertainty around how to understand and assess the state of the US economy today and what we should expect going forward. There's a lot of fear that we should expect some kind of contraction in the not too distant future. We've heard recession talk on and off for at least a year at this point. And in many different sectors across the economy, we're just not seeing a whole bunch of weakness. And that gets really interesting because, again, when you talk to these data-driven anecdotes versus what human beings are saying when they put together their own forecasts, we're starting to see a little bit of difference here. So that's always something I try to highlight when I come across those because it's a way to challenge ourselves to think a bit more rigorously about what we'd expect to happen for the US economy and economic growth as a whole. My last post was about solar power generation here in Texas. And July of 2023 was the first July on record where solar power generation exceeded nuclear power generation here in Texas. When you look at just July for each of the for the 5-year period, 2018 through 2023, you see solar has been on a compound annual growth rate of 60% across that window. And the next highest compound annual growth rate, CAGR, is wind at plus 16%. And the next highest CAGR is natural gas at plus 2%. So we know that solar is growing aggressively everywhere, and we know it's happening here in Texas. What gets really interesting is that it's on this 60% CAGR, even though it's already achieved the scale of having exceeded the power generation that we see from nuclear. So it's not just that it's growing quickly, it just happens to be in a sort of a minuscule scale at the moment. No, it's contributing real electricity to the Texas grids, and it's growing pretty wildly at this point. So worth paying attention to as we go forward to see what kind of roadblocks do we get to as these intermittent power sources become represent larger fractions of total electricity generation here in the state of Texas. Each weekend, I send out a free energy transition newsletter that includes links to and summaries of all the posts that I shared online during that week. I also include an energy-related anecdote, insight, or observation that I don't share elsewhere. So that way, no matter what you've seen or not seen online, you will always have something new to read in the newsletter. This week's anecdote was about US solar tariffs and how they show us a pretty interesting tension between energy affordability and energy security just within the solar side of this equation. We're used to seeing these kinds of tensions between oil and gas and renewables, say, but even within limited sectors of this broader energy transition, we're seeing this real tension. And it's interesting for us to explore and think about as we try to navigate and build expectations around what should happen going forward from here. So I've included a link to the newsletter down below. Feel free to sign up. Like I said, totally free. As always, I appreciate you reading, watching, listening, commenting, all the rest. It means a whole lot to me. Hope you had a great week, and we'll talk soon.